So let's open that question. 32, 32, 32, 32, 32. So let's read the question. Let's read the question. It says, and I read, Dynamic Limited has been reporting losses for the past few years. The creditors and shareholders have come up with a capital reorganization plan aimed at putting the company back on the path of profitability. The following is the summarized statement of financial position of the company as at 30th June 2019. So the balance sheet is, as you guys can see. The court approved the scheme of reorganization, and it was to take effect on 1st July 2019. Details of the proposed scheme were as follows. Your story already saw my note. It will just be a complete waste of time. Just go to required. Go to required. The capital reduction account to record the scheme of capital reorganization. Then the statement. So what we do for capital reduction, let's come up with capital reduction. So as we read, to Kisoma number 1, we make those adjustments. I think that will be better. Instead of reading all up to note 8, by the time you're in note 6, number 7, you don't even remember what you read in note 1. So let's come up with capital reduction. As we read note 1, we make the adjustments. So let's do that. Let's have capital reduction account. Capital reduction account. So shillings in thousands, millions. So have that. Have that. So let's start with number 1. So nikusoma tu na make those entries. So number 1 says, tangible assets comprised freehold property and plant valued at shillings 2720 million. So number 1 says tangible assets comprised freehold property and plant valued at 2720 million and 320 million respectively. So there is no problem there. While the intangible assets comprised patents and goodwills valued at 976 million and 896 million respectively. Patents and goodwills are to be written off. Even before we proceed, they have said they are supposed to be written off. Please, let's write them off. So we write off by debiting or crediting the capital reduction. We debit, yes, because these are assets. So when writing off an asset, credit the asset account, then debit the capital reduction. So let's do that. So write off here patents. So patents for how much? 976. So you credit those assets account, then you debit the capital reduction. So 976. Then we have goodwill. We have goodwill. Goodwill is 896. Goodwill is 896. Good. We proceed for an amount. An amount of 480 is to be written off inventory. How do you write off inventory? Inventory account, what will we do to the stock account? We credit stocks, because an asset. So credit the stock account, debit the capital reduction. So inventory is being written off. That is 480. Give us there. Next. And 374.4 million is to be provided for bad debts. So with bad debts, what are you going to do? See, you will reduce receivables by crediting. Sure. So credit the receivables account to reduce that value, then debit capital reduction. Actually, capital reduction is debited with those items or transactions which are perceived to be losses in nature. So any loss, we debit here. Gains, normally credit this side. So here you tell us receivables. So receivables with the bad debts. So bad debts of how much? 374.4. We proceed. The remaining freehold property is to be revalued. The remaining freehold property is to be revalued at 2480 million. That one has no issue. Actually, the remaining, we don't know the remaining afterwards, so we'll check. The investment was sold at the prevailing market value. Okay, so check. When we sold it at the prevailing market value, we gained, we lost. So can you check the investment in the books? It is somewhere appearing under current assets. So in the current assets, investment had a market value of how much? 896, while the book value was 352. So we gained, we lost. We gained how much? We gained how much? 544. So with the gain, of course, you'll have to credit the capital reduction because you'll increase the asset account. So you come here and say gain on sale of investment, that is 896 minus the book value, which was 352. So we gain 544. We gain 544. Correct? Correct. So number one is over. Let's go to number two. Let us go to number two. Let us go to number two. The 6% preference dividends are 4 years in arrears, of which 3/4 are to be waived and ordinary shares to be allotted at par for the balance. So the rule for preference dividends in arrears, already amount in arrears, when it comes to reconstruction, first of all, you assume they are accumulated losses. Not even you assume they are accumulated losses because they are those which were carried from the previous financial periods. So the way we normally recognize the preference dividends in arrears is that first you recognize them in full as part of the accumulated losses, then whatever will happen, you will adjust later. So you come and debit them here as part of the losses, And sorry, so preference live in arrears. Preference live in arrears. They have said they were in arrears for how many years? 4 years. And each year they were paying at what rate? 6%. So can you go to the balance sheet, you check the value of the preference, then we take 6%. The value of preference was 2560. Yes, if you check well, it is 2560. But now that is 1 year. They were in arrears for 4 years. They were in arrears for 4 years. So 6% times this times 4 years. Mm-hmm. 614.4. Then they say, so here we normally recognize them as part of the accumulated losses. Then they have said they waived. They waived what fraction? They waived what fraction? 3/4. So if when they waive, reduce that amount by crediting the capital reduction. So like waive here, you come it's an income on your side. So waived preference leave. They waived 3/4. So 3/4 of what was outstanding. That is 614.4. That is what they waived. So you credit the account to reduce that loss. Mm-hmm. How much? Huh? Oh? 416. 460.8. So not for this question only. I know this one normally brings problems to you. For all internal reconstruction, if there are dividends which were in arrears, first of all, recognize them as part of losses. Actually, the debit side of capital reduction records losses, this side records gains. So waiver is again because there's a debt. So first you recognize them as part of losses. If they waive, reduce that amount. Let's go to number 3. Let's go to number 3. The 6% preference shares are to be written down to. To be written down to, not by. To be written down to 15 shillings each. And the existing audit, no, let's just deal with preference first. So these people are reducing the par value of preference shares to shillings 15. What was the par value in the capital structure up there? The par value was 20. The par value was 20. They have reduced to 15. So we are losing how much per share? 5. So when you reduce, you debit the share capital account. Debit that capital account, then you credit which account? Capital reduction. So look, share capital, did you agree? It normally has which end? Credits. So when you are reducing the value, you reduce by debiting the capital account, then you credit capital reduction. Actually, that reduction, when they reduce, is a benefit to the entity. So you come here and say 6% preference share capital, 6% preference share capital, 6% preference share capital. How many are we having? How many shares were in the capital structure? They were 128. Good. So they were 128, and we are reducing with shillings how much? Shillings 5. Yes, because it was 20, they reduced to 15. So we are losing 5 for every share. So that is correct. You get 640. Give us here 640. Correct. Then continue reading. Note number 3. And the existing ordinary shares 2 shillings 4. The same thing. So ordinary share capital 2 shillings 4. So we are losing how much per share? 16. It was also 20. Yeah? So ordinary, we are losing 16 per share. How many ordinary were there? 240. And we are losing 16 for every share. So take 240 times 16. That is what we are losing. That is serious. So how much is that? 38.40. Let me respond to Mudoni. Mudoni is asking, why are we not debiting? Since we are losing 5 for preference share. So she's saying, why are we not debiting the capital reduction account? So according to you, should we debit? Huh? She's saying, why are you not debiting? What is making you to credit this account? What will be the corresponding entry in that preference share capital account? What will be the entry? When you reduce share capital, what will be the entry in this capital account? Yes. So you debit. Because capital itself is normally done what? Credited. So if you reduce, definitely you will reduce by debiting that account. So you cannot debit this, then again you debit that one. Don't? So you debit this, then you credit. But even the other interpretation is when they accept their share capital to be reduced, in quotes, that is a gain or an income to the company, because become you have accepted. Once we reduce, even the dividends will go down, because dividends is based on share capital. So once they accept, it is always a benefit to the entity. So you will have to bring it as again by crediting capital reduction. But if you check it from the double entry perspective, capital account is always credited. So any reduction, you will debit, then you credit this account. So I hope that is okay. All right, let's proceed to number. We are going to reach which notes? All the ordinary shares are to be consolidated into shares of 20 direct. That one has no issue. Let's go to note number 4. Let's go to note number 4. There are capital commitments amounting to 2,400 million, which are to be cancelled on payment of 3.5% of the contract price as a penalty. So there were some commitments the company had entered into previously, but now that they are in financial distress, they want to cancel those contracts. I want to get those contracts. The contract value was 24, and there was a provision that whoever cancels the contract before execution must pay 3.5% of the contract value. So when you cancel, you will credit the cash book with the penalty. So they will pay your penalty, 3/3% of the contract value. That penalty will be how much? 8. 3. 8 ama 8. 80 ama 8. 80. Yes. Ama 8. 8 without 0.
Okay, we are 1,000.
should be 80.
Oh, because it's passing this.
Christian, it is 80. Hiyo joy yako nayo. Si ufanye 3 and a third. 3 and a third ni 10 over 3. Chukua 10 over 3, then again divide by 100, then multiply by 2400. It is 80. So they are saying they were to cancel the contract, then they pay that penalty. So if you pay the penalty, credit the cash book, that is a loss to the company. So come and debit capital reduction with that penalty. So cash book, so cash book penalty 3 1/3% of 2400. I'm informed that is 80. I'm informed that is 80. That is 80. Good, we proceed. Why it has come to the debit side? Two perspectives. Number one, from the double entry. What is this 80? The amount they are paying as a result of canceling the contract. So when you pay, what do? The cash book. You credit the cash book. What will be the corresponding debit entry? So credit cash book, debit capital reduction. That is from the double entry perspective. But from other reasoning, it is a benefit or a loss to the company. It's a loss to the company because you are paying for something at your contract. So all losses during internal reconstruction must be debited in that account. You can argue well. So Alice, what is the issue? You have just joined. Mumeanza ama ulianza kitambo. Tumeanza. This is the first thing. Wait till get to hapo. You can even take a screenshot. Tumeanzia tu hapo. Haya, let's go to number 5. 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 Number 5 says the 6% debenture holders were to have their interest paid in cash. So you will credit the cash book, you will debit the debenture interest account because it was a liability from the unaona kama hiyo penalty haikuwa na account at your account hiyo haikuwa. They just came up with if you have refused you pay. So it was not a liability from the beginning. But debenture interest was a liability. If you check our current liabilities, kindly check our current liabilities. Kindly check our current liabilities. So now there is debenture interest payable. Yes. So the liability was there. So we have agreed that the 6% debenture holders were to have their interest paid in cash. So when you are paying, credit the cash book, then reduce the liability account by debiting. Sure. So that one will not affect the capital reduction. And to take over part of the freehold property at a book value of 640. So debenture, debenture holders and loan holders, they took over a property which had a book value of 640 at a valuation of how much? 768 in part payment of their holdings. So their loan, they have accepted to take over some property at a value of 768. But that property was having a book value of 640. So we transferred to them the property at a loss or at a gain on our side. At a gain. So gain of how much? Because the book value was 640, but we agreed to give them off at 768. 198. 128. Record. Someone has requested I move aside kidogo at the screenshot. So sawa. So the gain you will record here. Sure. So gain on transfer. On transfer of the property. Of course, you will debit the whole amount in the loan account to reduce the loan. So that is 768 minus 640. You are saying this is 128. So we gained on that. So the gain, you know, the whole amount will be debited in the loan account. Then the gain you will credit to the capital reduction. Next, still in the same note, the 6% debenture holders are also to provide additional cash of 832 secured by a floating charge on the company's assets at the rate of, that one has no issue. So now, now there is an issue, there's something on that freehold property. Can we go back to note 1? There's something they said was remaining. Go back to note 1. There was something in note 1. They said, are you seeing somewhere in note 1 they are saying the remaining freehold property? Are you seeing it? Yes, the remaining freehold property is to be revalued to how much? 2480. Remaining here means, what was the value of the property at the start? Still in note 1. Tangible assets comprised. Freehold property was 2720. However, they gave out, debenture holders have taken over. There is part of freehold which has been taken over. Sure. They took over at how much? 768. But that was not the book value. That is just the taken over value. So, book value was this. Then they gave out 600 and what? 40. So it means the remaining should be how much? What is remaining? Should have a book value of how much? 2080. Should have 2080. But they have revalued that freehold to how much? 2480. So the remaining was to have 2080. They are saying the market rate now, or the revalued amount is 2480. We are talking of revaluation loss gain. So you come here and tell us revaluation gain on property. So you will increase the value of property. That is 2480 minus in bracket 2720 minus 640. The remaining means after those people took over. And you can also subtract the 768. 768 but the book value was 640. So there is a gain of how much? 400. Number 6. Let's go to number 6. Let us go to number 6. The directors were to accept. Settlement of their loans as to 90% thereof by allotment of ordinary shares at par. So directors are given the company some loan, sometimes back. Now they want also to be compensated because the company is being restructured. So they said of the loan we gave out, 90% of that loan will be our shares. So we won't pay, let it compensate. So 90% of the loan, how much was the loan? Director's loan in the balance sheet, 640. So 90% of the 640 will be given shares. So reduce the loan by debiting loan account, it's loan credit side. So debit the loan account with 90%, then credit share capital to increase the value of shares. So it has no impact here. We continue reading. And as to 5% in what? Cash. Credit the cash book, debit the loan account. It has nothing to do with this. The balance of 5% was to be done what? Waived. So the one they are waiving is what we bring here. So no, you will debit the loan account, credit capital reduction. That is a gain or an income to the company. So waived D loan. D loan is director's loan. 5% of the outstanding. Outstanding was 640. So that one will be how much? Yeah? 32 hivi. Hivyo. Kidogo hari. Leo na wewe kitu serious. That is done. Let's go to number 7. Let us go to number 7. Let us go to number 7. The trade payables were to be paid shillings 0.4 in every shilling to maintain and obtain an extension of the credit period. Wow, walisema creditor said pay us 0.4 for every debt which is outstanding. You will credit the cash book, you debit the payables account. So that one will not affect there. Next, the bank has sanctioned an overdraft limit of 40 million to provide working capital. That is even irrelevant. It will not even be used anywhere. That note that it will not help. I the balance sheet because sahi fuliza wamekusantionia pesa ngapi? Ile limit wamekupea 10,000. Lakini ukitaka kuangalia liabilities, unaenda mpaka ile pesa umetumia. Ama kama fuliza wamesema your limit is 10,000 and you want to prepare your books, what do you bring in the books as liability? The one you have done what? You have utilized. So when you check current liabilities, how much have we used for the overdraft? 1248. That is what we consider. So what has been sanctioned means we are allowed to operate up to that limit. Past that limit will not be allowed. So in the books, consider the amount which has been utilized, not what has been sanctioned. So usichukue hiyo 40, utilize what has been, record what you have utilized. So ignore that. Correct. Kusha, we are done. So can you confirm if we are accurate? Actually, this account should balance. Check to confirm. Check to confirm. So check. Is yours balanced? Or let me see. Oh, there is one thing we have not captured. Walienda silent. Whether they are silent or they are not silent, it must be recorded. Accumulated losses. Are you seeing accumulated losses somewhere in the balance sheet? Are you seeing accumulated losses? During internal reconstruction, whether they say, they don't say, losses must be written off. Those are what are causing those problems in the company. So accumulated losses, yes, I've seen it. So write off all the accumulated losses, 20, 26, 24. Many people forget that in aquatic, yeah, bore. So can you check? Because how? With what figures? 60? 44? 44? 44? 64?
6044.
Yes, 60, 64 point.
64.
Oh, sema kizungu ya Kenya. 64.8. 6044.8. So I'm giving you 1 or 2 minutes. Kindly check to confirm whether you are understanding everything we have posted. Online kama kuna shida, niandikie hapo. Nyinyi mnaweza discuss kwanza pia na neighbor. Yes, please. Number 6, eh? Kindly allow me to address number 6 before you bring others. So number 6, they are saying, they were saying in number 6 that the directors were to accept settlement of their loan as to 90% thereof by allotment of ordinary shares at par. So one, you have to agree that director's loan is a liability account. True. Which was how much? 640. So of that 640, they said they have no problem. 90% of this, they are supposed to be given what? Shares. So when you give them shares, let them reduce the value. So ordinary share capital will take 90% of the 640. Then they said again, so the corresponding entry will be credit the share capital to increase the share. Then 5% they were supposed to be paid in what? In cash. So cash, they want 5% of that 640. The corresponding entry will be crediting what? The cash book. So you credit the cash book. So 95, 95. What about the remaining 5? The balance of 5% was to be waived. So when they are waiving against what? Silly loss on their side. So that is a benefit to the company, which will straight away go to capital what? Reduction. That 5%. So you'll complete it in the capital reduction account. So debit loan account, then credit capital reduction. So just go through everything we have recorded. You check if you have understood everything before we go to the next. Presentation is not the most important. Understanding is the issue. Where is your neighbor? Sylvia. This is your neighbor. In case of anything, online where you have an issue, where you need clarification, say it. Let me start with online first. Oh, online naona issue. Sawa. Yes. Eh? Clarification. I'm on the figure. On the revaluation, they said something. Revaluation is combining note 1 and note number 5. Check note 1 and note 5. In note 1, they say tangible assets comprised field property and plant valued at 2720 million and 320 million. So whatever 320 for plant. Field was how much? 2720. So that is the book value. Yes, then the last bit of note 1, they said the remaining freehold property is to be revalued at 2480. To be revalued at 2480. Remaining after what? After note 5. So check note 5. Note 5, they said the 6% debenture holders were to have their interest paid in cash and to take over part of the freehold property with a book value of 640. So 2720 minus the one which was taken over. Sure. Then now that is the remaining. So what remained? 2720 minus 640, 2080. Then they said it was revalued to 2480. So that's revaluation gain. So that gain, you debit the asset, then you credit the capital reduction. So that's how it came out. So that is what, yes. Note number 2, yes. Note number 2, umeelewa. Yes. Note number 2, the 6% preference dividends are 4 years in arrears, of which 3/4 are to be waived. So you are in a shida when they waive, and ordinary shares to be allotted at par for the balance. So see, in a shida. So when we check this, in total, in full, we recognize the preference dividends in arrears as part of the losses which we brought from the previous years, 614.4. So to clear it, 1, they have accepted to waive 3/4. Then the balance which is remaining, they are being given shares. So when we go to the balance sheet, you will remind me, ordinary share capital will credit the account with the amount we are going to give those people. So we are going to increase the shares. We are going to credit the share capital account to clear the balance. So the balance they took over shares, so we credit. We have credited here with the waived one, then the one which is remaining is going to be credited with the share capital account. So, Judith, note number 8. Note number 8, I said there will be no, it is irrelevant when they say they have sanctioned an overdraft of 40. Sanctioning means, sanction means the limit. Yes, so we have a limit of overdraft of 40. But now when you have been given a limit, what you recognize restricted, the way Mugon is saying, what you need to take in the books, even in reality, you take what you have utilized, not what you have been restricted to. After mshwari wanaweza restrict to 10, but if you have used 6, then 6 is what you recognize in the books. So Judy, I hope that is okay. Good. Now we need to go to the statement of financial position. However, there are some 2 accounts now. So many issues we have to adjust: ordinary share capital account and the cash book. They have so many things. So allow me, as part of working, we come up with the ordinary share capital. Ordinary lazima hata ufanye hata kama utapata so many during internal reconstruction. Ordinary is seriously affected. So let's adjust the ordinary share capital account. We can also do the cash book. Then now we can do presentation. So right for me there, ordinary share capital account. So now check here. This is 8 months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I think it's 16. Cover is 16, I will say 12, 16 and a half. So this one is any 8. Any 8 and 1. So what's the part 8 takes out of this? So let me tell you what people will get. What when you want to stress, anything, this one they will always get. This one here, this, that, this one they get. This one can bring problems. I know what students will always get very fast. This one they will get, and that one, you're in Guinea or I know. So without struggling, people will get 1, 2, 3, 4, 5, 6, 7. 7 over 8 is fine. So kujipanga tu. Let's do the ordinary share capital account. Ordinary share capital account. So ordinary share capital account, this is just a working. You can do without, but you miss out the mark because you need to adjust. That is a work. So we'll start with balance brought down. We'll start with the balance brought down. So balance brought down Balance brought down. How much was there for ordinary? 48, huh? So give us here 48. Then there was a reduction. Huh? They were reduced to shillings. How much? 4. Yes, well, we were losing 16 per share. So with the reduction, debit the ordinary share capital account, reduce those shares. So capital reduction. How much was the capital reduction in the capital reduction account? Huh? 38.40, sure. 38.40. It was reduced by 38.40. Now, tell me, I want you to check across. You tell me that I think this note should affect the shares. So I'll go with what you will say. Check those notes, then the one you feel affects the ordinary share capital, you can raise up. Number 2. Ile number 2 yako ya waiver, number 2, they say the 6% preference dividends in 4 years in arrears, of which 3/4 were to be waived, and ordinary shares were to be allotted at par for the balance. So if you are giving them shares, credit this account. So preference, leave, in arrears. In arrears, we gave balances at quarters, because 3/4 were waived. So a quarter of arrears was 614. Yes, it was 614.4. So you know their shares, so the shares will go up. So number 2 is okay. Kelvin, the same number 2. How much is that? 153.6. Help me with another note which you feel we can check on, which affects ordinary share capital. 4. So let's check number 4. There are 4. Number 4. Wacha kidogo tu Fatma. Yes. There are capital commitment amounting this which are to be cancelled on payment of this. You only cash books, So share capital. How does it affect? The word capital. Capital commitments is capital commitments means the project. A capital project if they want to construct maybe non-current asset. A capital commitment is a commitment to construct or to purchase an non-current what? Asset. Yes, Fatima, what are you saying? Because I'm being told by so many people online to check note 6. Check note 6. Note 6, note 6. Mohammed saying note 3. Let me go to 6 first. The directors were to accept settlement of their loans as to 90% thereof by allotment of ordinary what? Shares. So directors loan, 90%. How much was their loan? So go to the liabilities and check the loan. 640. So what is 90% of 640? How much? 576. 576. Then Mohammed is saying number 3. We check number 3. The 6% preference shares are to be written down to 15, and the existing ordinary shares to be written down to 4. So that is what we have done here. That is how we got the 38.40. So Mohammed, that one has already been captured. What about note number? Which one? To consolidate. When you consolidate, you still have the same value. So that one has no impact at all. Any other? Mudon is asking, how did you people get 38.40? Where is 38.40? So they reduced to 4. So they were losing how much per share? 16 times 240 is quickly 3840. Doni? Oh, you know, not everyone. So anything else? Any notes? Ruth, yeah, where kuna yenye umeona hata moja? Ama the ones you saw are the ones which have been said. Sure. Number 1, no. Number 2, we done. Number 3, done. Number 4, nothing. Number 5, nothing. Number 6, done. Payables, no. Quisha, there is nothing. So you can balance the account. So balance, carried down. No, instead of taking a photo, just go online, then you take screenshot. It's better than the photo. So just log online, then you take, yeah, that will be better. So I just project the camera, that one will be. So get the balance carried down. 1689.6. Good. Hey, Sylvia. The greater which you are underlining. Want to forget the colors. Let's do the cash book. But for ladies, that is okay. There's no struggling. So cash book. Let's reconcile the cash book. Then we can do the presentation. Let's do the cash book. So don't ask her, how do you know that we are supposed to do cash book? Because in the review Maramiki, there are so many issues they are talking about cash book. So in the cash book, balance brought down, I'm seeing an overdraft. Sure. There was no cash available, but under current liabilities, you are seeing an overdraft from how much? 1248. So balance brought down 1248. It was an overdraft. So I want you to go to the notes. Collect for me things unaona in affect cash book. Already, Mohammed is saying, please check note 4. They are capital commitment. Yes, that's penalty. The penalty, I remember it was 80. Sure. Yes, the penalty was 80 and it was to be paid. So you credit the cash book. Then I'm being told note number 5 by Achien. So note 5. The 6% debenture holders were to have their interest paid in what? In cash. So debenture interest, check it under current liabilities. You'll be able to see it. Please, where we have reached this class, unless under extreme conditions, be here until the end. Because here we are done, waiting for exam. You are safe. Debenture interest is how much? Is that 144? 144. After year 5, the last bit of note 5, they are saying the 6% debenture holders are also to provide additional cash of how much? So when they provide cash, it's going to be there. So debit the cash book. So 832, 12%, yes? 12% debentures. 832. What were you saying? Which note? Yeah. Number 6. The directors were to accept when you are 5% in cash. So directors loan 5% of the loan. Their loan was how much? 640. 5% of 640, I think we got 32. Huh? Yes. Kwani if you secure security, security. Tunapenda cash but in security. Bank ikupea loan. So wanakuishia security. Ama? You're just confusing yourself. What if you secure? Huh? Ukienda kwa bank wakupea loan, ungejipata wewe uko banki loan, si ndio? Lakini ukipewa loans wanakuchia security. You leave the security, then they give you cash. Of course. Number 7, I'm being told by Bill Hub. We check number 7. Trade payables were to be paid 0.4 in every shilling to maintain. Yes. So creditors wamesema hata wao hata hiyo biashara ya kuongeleshwa kila saa kibia financial crisis. They said they should be paid 0.4 for every shilling they are owed. So how much are we owing them? Yeah? 1,600. So 0.4 by 16. 640. So they also said they want to be paid. The one I'm capable of seeing very fast is in note 1, the last bit of note 1. Kelvin, I'll read what you have said. Note 1, the last bit of note 1. The investment was sold at the prevailing market value. So when you sell, of course, you are getting cash. So investment, how much did we sell the investment? It was in the books. Just check the market value. Yes. 896. So note 1 done, note 2 there was no cash, note 3 no cash, note 4 done, note 5 done, note 6 done, note 7 done. Overdraft we don't want. Question. So Kelvin, I've already seen your question. We are going to answer that. This is going to balance this side because this plus 600 now is 18. This is 16, so this side is small. So it is still an overdraft. So give me it is an overdraft of how much? In terms of so you can keep when there to difference. Investment imetoka wapi? Neighbor pia hajaona. Joy is saying 416. So let me clarify the issue. So let me start with Ruth. 1248. So ukiangalia liabilities. You know when we talk of the cash book, which is the bank or cash in hand, is either cash available can be an overdraft. So cash available under current assets, we are not seeing any cash. But if you go to current liabilities, what is the crime of bringing it down there on the credit side?
for the amounts of the debit side is money out.
Yes, definitely. When overdraft, overdraft, according to you, overdraft should be on the debit side. And the same question you are asking is what Kelvin is asking. Ukipata overdraft, what should be the double entry? That is what he's asking. What should be your double entry when you get an overdraft? Now, this is a question to accountants who are in the room. He's asking, what is the double entry when you get an overdraft? Yes, the liability. So he's asking which account, which account should you debit and which one should you credit? CFR, you CFR. So you is only to accountants. Mohammed kidogo kwanza tujibu hii. Is asking ni kitu tunafanyanga kila siku kwa office. Tumechukua loan pale overdraft. Which account do we debit and which one do we credit? So Anne is saying debit the loan account and credit cash book. Judith is saying debit the cash book and credit overdraft. As accountants are speaking. Credit bank, debit the overdraft account. Which is which?
When I have money in my cash, I just, if I take an overdraft, means I have money.
Yes, that is true. So I know that question is what is confusing Kelvin. So according to you, overdraft should be money available on the debit side of the cash book. Hey, and you want to say yes? Yes, it's available because I have. See, negative cash. When you get the overdraft itself, the way people are saying, when you get the overdraft, of course, you will debit the cash book with that amount. You credit the overdraft account, but remember that cash book is a negative. It's a negative figure. So debit cash book, credit back, whichever. What you should know, overdraft is negative cash balance. So there is no way you can bring it. Okay, that is your money. This is not your money. So I hope I couldn't confuse nikapita watu wengine. So Barbara, ni sawa. Accountants wameongea debit and credits, overdraft and mwingine mpaka ameandika underdraft. Kuna maana kitu kinaitwa underdraft. Kuna underdraft. So overdraft is available but it's a negative cash balance. So we can now do the presentation. Let's do presentation. They want the statement of financial position. So andika hapo dynamic limited. Dynamic limited. Statement of financial position. Statement of financial position as at that date. Hebu jifanye tu umeanza hiyo balance sheet. There is no crime, just hata rough huko nyuma. Hebu just pretend you are starting so that when you make a mistake, we correct, you will be able to see. You know, tukifanya na mimi inakuwa very easy. Just try to see the way you are thinking. In fact, don't consult neighbor. Just do you as you. Hata unafaa ushikilie nyuma ya kitabu hivi neighbors yaone. Jifanyie wewe mwenyewe. You just pretend you are starting the presentation. Mohammed, will payables be affected? Definitely. Walilipwa 0.4. So tukienda payables tutapunguza na hiyo 0.4. So 60% is what is remaining. Mohammed, yes, they will be affected. Unafuata hiyo balance sheet yao, but now una adjust where there was no effect, record the way it was. Separate for me those tangible assets. They were broken down into two. There was property and there was plant. So separate the two of them. Just try to separate. Separate the two. As at when? Yeah. 1st July. Wewe post tu zako venye unaziona, mtu asikusumbue. All right, so we can present it together as you mark. So I will stick to their balance sheet. So non-current assets. Non-current assets. We have, so tangible, I want to separate them. We separate them into, so freehold property. Freehold property, the ones which were remaining were revalued to how much? 2480. That is what we go for. But so we told you to repair for our loan. So the remaining is what you're supposed to consider. So the only issue is that the remaining was revalued. Once you revalue the asset, the revalued amount supersedes, supersedes the book value or takes over. So we had already subtracted, which was the right thing to do. There? There? Sikuelewi vizuri Fatima, kidogo. The 640. Si tulitoa na wakasema what was remaining. Remaining means after subtracting 640. What was remaining was revalued to 2480. So don't even overthink. Bora wasema what is remaining. Umeelewa? Haya. Then plant was not even interfered with. Sure. How much? 320. So this one comes to 28. Kama ulipata weka T. Mpaka andike very good. Continue with the same spirit. Now andike hapo is back, here we come. Current assets. So just follow. What are you now? Inventory. Inventory, there was a write-off. Yes, so it will be 2720. The write-off was how much? 480. So minus 480. You get? 2240. Receivables, also there was bad debts. So receivables, take the bad debts, so the value was 3104, minus bad debts was 374.4, giving us 2729.6. Then the cash book was still an overdraft. So it had no change. So add the two. You got 40? 49? 69.6. So total assets. No. Muru anasema here from the look of things, ati kitu peke yake ingemwangusha si figures, alijua hizi ameweka hapa. Hiyo inaweza kuangusha. Ati instead ya kuweka hakuna debit and credit. You can operate one column actually, there is no problem. Operating one column means you are doing it in published form, so there is no problem. Ati ungeanguka tu, ati figures there is no problem. Problem ni kuweka hizi. Hiyo hizi kuangusha. Utapita asubuhi. So this one is how much? 77, 69.6. Pata unaongeza 0. Equity and liabilities. Imagine mtihani itakuwa tu hivyo. Itakuwa tu hivyo. Utaona tu maswali zinakaa familia. Equity and liabilities. Ordinary share capital. Ordinary share capital was interpreted so many times, we reconciled. Give me that value. 16.6. Sure. Then Under equity, preference. But preference, there is an issue. Check the last bit of note 3. The very last bit of note 3. The rate of dividends on preference shares is to be increased to. So don't talk of 6. It is now 10. 10% preference share capital. But kila kitu the rate the same. There's nothing to change. The rate is what they are changing. How many preference are we having? Preference of 128. However, they were reduced. They were reduced to how much? 15. So you multiply by 15. 19? 19, 20. They were reduced to 15. So that is now the value. Yes. So you multiply, it was 20, but it was reduced to 15. So you multiply by 15. Then after that, there is nothing. So add these two. 3609.6. Non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities. There was the 6% something. 6% debentures. 6% debentures. How much was the outstanding in the balance sheet there? The outstanding was 24. But sikuna property tuliwapea. We gave them a property to reduce the balance. So you will reduce. So it will be 24 minus, they took it over at what value? 768. Huh? Yes, I was to add the 832, but you see now the problem. This 832 they gave us on one condition, that the interest will be what rate? 12%. So those are two different things. So 12% debentures, 832. They gave it on a condition that it will have a rate of 12%. So, but if that was not there, then it just stop it up there. So this one comes to how much? 1632. Okay. Current liabilities. Current liabilities. Are they many? There are only 3. All right. We'll fix up. So current liabilities, payables. Payables, how much was the balance? It was 16. But there's somewhere they said they want to be paid 0.4. So you can now work here with the outstanding 0.6, or you take the 16 minus, it was 640. Yeah, so you can take 16 minus 640, which was the 0.4, or you work with 0.6. Which one is making you happy? I to be 16 minus 640, or 16 times 0.6, 1 and the same. That one will give you how much? 960 here. Then bank overdraft. I don't have space. OD is the one we reconcile. We still got an overdraft. It was how much? 416. Give us here. And finally, the debenture interest was paid. Sure, that was settled. Accruals was not touched anywhere. So I have accruals. Accruals online. I hope you are following well. Camera, wacha niwawekee camera there. Accruals was how much? 320. Then director's loan was settled in full. That 90% was given shares, 5% waived, 5% cash. Crucial. That is all. So can you add that? Then you get total equity and liabilities. Current liabilities comes to 1696. So total equity and liabilities, are you getting 7769? Then that is okay. It is not that dangerous. Right? It's not hard. So for internal, I will do one more. We will do one more. For last setting they brought internal. So right there, December 2021, let me check that question. So December 2021, question 4. That is page 10. December 2021, question 4, which is page 10. Okay, online, I hope. Page 10, the last page 11, back at 12. So we only have 9 minutes to class end. So can you go and attempt that question? There's something I want to clarify so that you can be able to attempt. Check that question. Your story in and your two stories, except I've not read the question, but I want to make some clarification for A. In that question, A wanasema they require. They want the journal entries to effect the scheme. So journal entries, very simple. Journal entries in financial reporting means which account to debit and which one to do what? To credit. So we have been doing journals often without you knowing. Upper for capital reduction here. We have been doing it often. We were saying they have reduced the share capital. So we are saying debit share capital, credit capital reductions. So in the journals, what you will be doing, you yenye umesema, unakuja hapa unasema, kama umepunguza capital, debit the ordinary share capital account with that amount, then you credit capital what? Reduction account with the same amount. So as you read number 1, you pass the journal. What do you think? Which account should be debited and which one should be credited? So you show it that way. That you can attempt actually. Na kama hiyo ikufurahishi kufanya hiyo ya pili, statement of financial position after reconstruction. That one you should get, because when you check note 1, you will get the restated figures. So in the new balance sheet, we agreed we take the restated values. So weka utaki stress ya journals. Hata unaweza anza na hiyo. You start with that one, then you will lose very few marks. Hapo kwa ordinary share capital hiyo unaacha, then unapeana hiyo. Journals is just which account to debit and credit. Can we do that tomorrow? Can we do that tomorrow? So tomorrow is your first time. Naona umeshtuka hapo nyuma sana. So tulisikizana because of time. We'll be coming on Sunday. For those people who have just joined us today, online I can see we have 44 participants. So the 44 there, we must have someone new. So tomorrow we are meeting from 9:45 a.m. to 1 p.m. So we'll be able to finish the internal with that question, and I will introduce external. Now, because internal came, the way it's predicting exam, because internal came, there is high possibility they can bring external reconstruction. So miss at your own risk. Kidogo tu. Christian, how did you arrive at the overdraft figure? It was, there's account we prepared. The 416. Ebu check the cash book. Christian, check the cash book. There. Wapi. Destiny. So someone is asking now something apart from this one. In this college, is there provision for doubtful debts? Yes, yes. Okay, we do have. In fact, I'm the one who does it. Why are you asking that? No, we don't have that one. We only have provision for doubtful debts that maybe a student started and never finished. So the installment in a hotel. So, so you are good. So come with your lunch bag and eat a few hours. You know how many hours? 10. So let's make that time. To manage the internal, we'll start external. External is a agent. Is standing a very good chance of being examined. So make sure you are present. So by next week, no one class on Monday. Monday, Tuesday, maximum reconstruction. I will decide whether we start group accounting or we go to earnings per share. This will be the Kisha. FR is as good as coming to an end. So prepare. Thank you. Have a nice weekend. Nice weekend, but we meet tomorrow. Those who are new, make sure you have the notes.